Welcome, everyone. My name is Pete Chrysos. I'm one of the National Account Managers here at Protective Life. Thank you for joining us for the first event this year in our Protective University online series. During Protective University, you'll hear from experts about the news and trends in our industry and also learn best practices to help make doing business a little easier. Before we dive in, I did want to cover a few housekeeping items. If you have any questions during the webcast, please submit them through the chat function. We'll follow up with you after the webcast to answer your questions. In addition, you'll receive a recording of the webcast after today's live event, so you don't have to worry about taking notes or screenshots. To present today's webcast, I'm proud to introduce my fellow colleagues, Tom Hall and Nick Lyons. Tom is a Divisional Vice President for Protective Life. He is responsible for managing all life insurance sales and wholesalers in the 26 Western states. Prior to joining Protective, Tom held VP positions with AXA and Transamerica Capital. Tom started his insurance career as a financial consultant and life agent with MassMutual. Nick joined Protective in 2012 and became a regional vice president in 2014, working in Southern California and Nevada. Here at Protective, Nick helps agencies and producers gain a competitive edge to secure more life insurance sales and has significant industry experience as a life insurance agent, a wholesaler, and a specialist for high net worth individuals. Tom and Nick will walk us through 3 case examples that you can start using today to create more business using our GUL products. To start us off, Tom will talk about some of the industry changes we've experienced recently. Tom, thanks for joining us.
Great. Thanks, Pete. Good to be with everybody today. And our theme today is cost of waiting and death and taxes. So, hey, Nick, how you doing?
Doing all right. Hey, Tom. How's it going?
We're back together on video. Here we are again.
About time.
Hey, speaking of death and taxes, I want to start off with some trivia time. Do you know, related to our talk today, who was the first person to actually use the phrase death and taxes?
I'm going to go with Mark Twain.
Okay, many people would say Mark Twain. I thought that was true as well, but years beforehand, there were actually 2 other people that actually used that phrase before him. First one was Ben Franklin, recorded in the history books that he actually used the phrase death and taxes after signing the Constitution, believe it or not. And years before Ben Franklin, there was another man named Christopher Bullock. He was an English actor and author, and he was quoted as using the phrase, "'Tis impossible to be sure of anything but death and taxes." So, a little trivia to get us started off, my friend.
There you go. Lifeline, please.
Hey, as you know, we've been doing a lot of research on this this topic of cost of waiting, and did some more research on it and found there's actually a paper written out of the University of Dubai that came up with the phrase procrastinomics, which tries to actually quantify the actual cost of waiting and its economic impact. So that's what we're going to be looking at today, is this cost of waiting as it relates to insurance. There was another study I found by a company called Basics, estimated the lost productivity in the workplace, ready for this, Nick? $650 billion a year.
Wow.
Due to procrastination. So there's procrastinomics again. Another study showed that 40% of Americans wait till the last minute to do their tax return, and that procrastination costs an average of $500 per person.
That's me.
Again, more cost. Yeah, me too. I wait till April 15th. And then how about some practical stuff that we do normally, like home repairs and car repairs? We'll put those off, right? And if you wait, it can cost 2, 3, 4 times what it would cost if you had done it earlier. Okay, there's a cost to waiting, right, Nick? Procrastinomics. So why are we talking about procrastinomics today? Well, today, what we want to try to do is look at the cost of waiting as it relates to buying life insurance. And a lot of times, agents and advisors will hear from their clients, "I'll buy life insurance when ... right? Fill in the blanks. When the tax laws change, then I'll buy life insurance. When I have more money, then I'll buy life insurance," right? But what happens is there's a cost to waiting. So today what we want to do is give everybody some opportunity here that's listening with some sales ideas that can help get your clients off the fence and make a decision today, a good financial decision today. Okay, so Nick, let me set the stage real quickly. Thankfully, even through this very tough year, Protective Life has continued to thrive. We launched a new GUL last year during low interest rates and all that was going on. We have a competitive IUL product. We continue to grow sales, and we're hiring people. We've actually hired over 150 people in the last 6 months, and we're still hiring. And so when a lot of carriers are getting out of the life insurance business, they're getting out of the GUL space, we continue to grow and help be positioned to help BGAs grow sales. Okay, so Nick, you talk to a lot of BGAs every day. You're talking to agents, advisors. What are you hearing, and what are we gonna share with everyone today?
Thank you, Tom. So today, first, we're going to cover 3 things that help address clients' procrastination and help you close more GUL cases. So first is going to be the cost of waiting. And we all know clients, they, as you said, they have a myriad of excuses and reasons why they may not buy, but we're going to dive into some actual stats addressing the risks with putting off the purchase of life insurance today. So we're going to cover that. And then number 2, we want to talk through a very simple basic strategy that we all use, we all sell, we all talk about, using a low cost level premium GUL with lifetime insurance, and how the ROP can help address clients' objections and get them to make the buying decision today, right? And then number 2 sales idea that we have on our list is a step premium design using our Advantage Choice GUL, and how you can use it to get a reluctant client on board, someone who might be budget conscious or averse to writing that big check today, right? How do we get them on board? Step premium design might be a tool that you can use. We've had success with it, and that'll be our second sales idea that we're going to cover today on the agenda. But Tom, before we get into the success and opportunities that we're seeing today, I think it's helpful to first touch on what got us here, right? So one could argue that 2020 was full of reasons that were excuses, right, for estates to procrastinate or hold off on buying that large insurance policy. We had an election year, we had a tremendous amount of economic uncertainty amongst other things, right? And also underwriting restrictions. So I think all of us on this call today would agree that we felt some pain when some of those larger premium cases dried up. But there's a silver lining. So we have uncertainty, a lot of uncertainty around the future taxes. There's pent-up demand that we're seeing, play out today, and also, frankly, the realization of one's own mortality. And so when you package all those together, as a protection-focused carrier, we have seen a major rebound in those 5- and 6-figure GUL cases today in 2021. And based on mine and my counterparts' conversations with their customers, many more planning discussions are now taking place. Groundwork is being laid both from a case design standpoint and underwriting standpoint as well. And it does seem that the larger estates are now looking to address their insurance planning in phases, right? So if you take an estate that may have a $5 million estate tax exposure today, we're seeing several million being placed. Maybe not the full boat, but $1, $2, $3 million in place today to address a portion of their need and help them kind of wait and see, right? The other opportunity, Tom, I'll cover is frequent flyers, right? Those are clients that may have placed a case in the last 12 to 18 months, right? And then they're looking to come back for additional coverage, especially on those cases where the underwriting requirements are still fresh. They haven't yet expired, and we can add an additional policy with very minimal effort. So there's an idea for you, Tom. Jot down your top 3 cases that you placed in the last year or so, and go back and try to revisit them for additional coverage. Maybe you can sell another policy.
It's a great idea. I mean, nothing better than having to go back to a sale that's already been made and let's sell some more policy. Let's sell some more insurance. So let's focus. So let's jump in. Let's jump into this cost of waiting. There's lots of talks about tax laws are going to be changed. We've got the sunset provision coming up in 2025. But let's jump in and talk about some of these ideas.
So, Tom, when we're looking at clients who are holding off purchasing that policy, there is a material cost to doing so, right? So those same clients who chose to wait it out and see what happens over the next 4 to 5 years are taking on significant risk, not just with product or pricing, but there's underwriting risk to consider. So let's open the hood and take a peek at what that actually means for those customers. So this table here shows you Protective's rate class experience by age group, so 60 through age 75. And the data provides really just a snapshot of UL policies for applicants at these ages who had a final action on their policy. So approved, declined, postponed. And we break it down by underwriting group. And so what you'll see here is that as this cohort ages, as they get older, there are fewer and fewer best class, preferred classes, and the rate of decline in postponed cases increased significantly. And so just, a couple observations here for you, Tom. 1/4 of the cases that were approved at best class at age 60 drop all the way down to just 1/10 by age 70. So over 10 years, you see a steep drop off, right? Pretty staggering. The other thing I'd note here is, as we're looking at this, the rate of cases that are declined or postponed, 29% at the age 60 cohort, so about a third. We see that jump to 45% just 5 years later, and over half of those cases at age 70 are either declined, postponed, or rated. So how's that for a cost of waiting, Tom?
The underwriting risk is real. There's no doubt about it. So as you've said here, you're going to go from a third up to over a half are going to be rated or declined at some point. So as you get older, the risk is real, right? So here it is. Thanks for sharing that, Nick. That's good stuff. Let's talk about how we get clients off the fence now. What are some of these ideas?
Great. So let's take a peek here at what we have for you guys today. So first of all, it helps to walk through an example. So we put a case study together. We have Stan here, standard Stan. Typical client, male, 60 years old, standard health, $5 million estate tax exposure. And so he's looking to buy a $5 million policy today. The first sales idea we're going to cover with you is our lifetime insurance GUL. It's a level pay. Think of it like term for life almost, right? Very simple, straightforward, low cost. Now, Stan can expect to pay a premium of $100,000 per year to guarantee this to age 105. Now, Stan's a savvy guy. He understands the value of an IRR, rate of return. And so he's looking at his life expectancy, which we set at about age 88 for today's demonstration. He'd have an IRR of 3.74% or a 5.75% pre-tax equivalent yield on a guaranteed basis, right? Pretty good. I think we'd all agree. Now, here's the kicker. So there's a 25% ROP feature that turns on in year 10 with lifetime insurance, and it doesn't go away. So he can exercise this ROP and get out at any point from year 10 forward. There's no 60-day window that he has to exercise within, nothing like that. So it's extremely flexible. And Stan here can have the peace of mind that he can recover a portion of his premium paid if life happens, if things change. I think the best analogy that comes to mind with an ROP is, think of it like a life jacket, right? A life preserver. And if Tom's a fisherman, I like fishing. We're not going out on the water without a life preserver on, because if we end up in the water, we want to have something to protect us. I think of ROP in the same way. If something happens unforeseen, right? You want to have that safety net, that safeguard. And so think of what scenario would Stan need or experience in order to trigger an ROP provision to surrender his policy. Think of, it could be a change in his estate or estate taxes. Maybe there's a divorce, right? Or perhaps a financial hardship. With lifetime insurance, if the plan changes, Tom, down the road, the ROP guarantees that he's going to get something back in year 10 and beyond. And not all GULs give you that today, or frankly, are as flexible as this one. So that's the first concept I'd like to share with you. The second one here is
quick. I just want to emphasize that, Nick, just to reemphasize that point. So if someone's got a liquidity concern, hey, I may need this cash because of a health issue, or like you said, an estate tax change, or something may happen, they can get a portion of their money back down the road. So it's a great opportunity to talk to clients about, hey, here's a liquidity feature that can help you get back out of the product. So I love it, Nick. That's a great idea. What's the second idea?
Thank you, Tom. And great point. So talking about liquidity, let me show you something that offers a tremendous amount of liquidity here. And this is our second sales idea. It's a step premium design in year 5, right? So in this case, again, Stan's looking at that sunset provision coming up here and starting in 2026 and thinking, hey, well, what if I do this instead? Use a step premium design with Advantage Choice GUL. And so essentially what Stan's looking at is paying a much lower premium in the first 5 years and then stepping up years 6 through 105, right? So on a guaranteed basis, Stan is able to pay $53,000 for the first 5 policy years and then increase that to $120,000, guaranteeing coverage all the way out to 105. Now, if we're looking at it from an IR standpoint, Stan is going to make a minor sacrifice, 54 bips at life expectancy, for the benefit of paying significantly less in the early years and see how things play out with estate taxes. Not to mention, Tom, there's also $189,000 in retained savings over those first early policy years compared to buying that level pay with lifetime insurance and the 100K all years to 105. So there's a nice sales idea for you as well.
Well, so if you've got an advisor, an agent that's trying to sell a $100,000 premium, and now you could show them a way to start it out with a $53,000 premium. That's a pretty good sales idea, right? To be able to get those clients off the fence that are saying, hey, I want to wait until I get more money. So this is a great idea. A couple things come to mind though. Talk about comp for a minute, because we're now reducing the premium. Talk about compensation and talk about how is this easy to illustrate.
Great point. So yeah, folks at home, you're probably wondering, well, it's so fantastic. Nick, Tom, you just showed me how to cut the premium in half, right? What does that mean for my commission? Well, good news is Advantage Choice UL has a rolling target. So despite the significantly reduced premium, half of what you pay with a level premium design, we give you 2 years to make your commissionable premium whole. So that's nice. So you're not leaving any money on the table with Protective Life. Number two, as far as illustrating this, whether you're using WinFlex or our own homegrown illustration software with Eli, as long as you're doing the initial step at age 75 and beyond, the system does it for you. It's very, very easy in terms of establishing the lapse protection tiers. So, maybe it takes another 5 seconds over just a run-of-the-mill level premium illustration to build those steps. And so very, very easy. The other thing I'll mention to you, Tom, and our folks that have joined us today is that Protective also bills as illustrated. So as you're running a case design for your client, let's say there's 1, 2, 3 steps built into their insurance plan, where we have multiple increases, maybe every 5 or 10 years on for their insurance policy. When that increase comes, Protective, we will bill the policy owner or the trustee, what have you, like clockwork, automatically for that increased premium. So it takes a lot of the onus off of you and the folks those of us on this call today as well. So another big advantage with using step design with Protective.
Wow, that is a great feature that we've got built in. I don't think there's too many carriers that will do that, but we actually bill as illustrated. So that's a key point to remember from today. Thanks for sharing that. What else do you want to share about the concept?
Well, I think just to recap here, Tom. So as we're looking at the solutions that we put forth here for Stan, if he bought the lifetime insurance GUL at his current age 60, his cumulative outlay to age 88, life expectancy, is about 2.8 million, right? Had he implemented the step premium design, right, using Advantage Choice, paying just 53,000 in the first few years and then stepping up to 120 out to age 105, his cost basis goes up a little bit, right? So now we're looking at about $3 million at age 88 or life expectancy. Now, I know what you're thinking. What about buying term and converting in the future, right? So let's cover that. There's a cost to buying term and converting in the future, and it's not a small one. So Dan, sure, he can pay in once the future of estate taxes seems more clear, but based on today's numbers and products, and that's a big if, right? It'll run him about 3.4, 3.5 million or 600,000 more over simply buying just a level premium design that we covered in option 1. So, over $500,000 in additional premium to buy term and convert. And I know that's, something we all run into frequently where they say, well, we'll just buy the term and convert. If you break down the cost of doing so, it might deter, a client or two and get them to buy the permanent policy today. So not only is the IRR going to take a hit, but it also assumes product pricing are still favorable at some point in the future. So
wow, that is procrastinomics right there. That is procrastinomics, right? Well, hey, Nick, thanks for sharing all of this. I think we're about coming to the end of our time. So as we kind of wrap up, what are the 2 things you want the BGAs to remember and that are listening today? And what are some of the next steps as they go back to their offices?
Thank you, Tom. So I think number 1 here on our list, and put a star next to it, remember the step premium design, right? Clients can dramatically defer their higher premium for later years to fit within their budget today and locking in their insurability. And it's just a fantastic tool for these types of sales and opportunities, especially if we want to get them off the fence and buy today. So I want you to think of your largest 5 cases you've worked on in the past 2 years, whether they closed or not, right? Jot them down now on your notepad in front of you and think to yourself, did they have additional insurance planning that still needed to be done and they didn't tackle it back then? Is their estate large enough to warrant a concern about the sunset provision? And would a step premium illustration get them closer to making a buying decision today? So as we think about those things, if you have a case in mind or you just want to see what a step illustration looks like, please reach out to your protective sales team or your general agent. And we'd love to share how our suite of GUL products can help you reach your goals in 2021 and beyond. Thank you.
Awesome. That's great, Nick. Thanks again. Procrastinomics, right? Cost to waiting. So let's encourage these advisors and agents to help their clients to get off the fence by using some of these ideas today. So thanks again for allowing us to share these ideas with you today, and we wish you all much success in your sales this year. Pete, back to you, my friend.
I want to thank Tom and Nick for sharing this great information. I'd like to thank all of you again for joining us today. For those of you who submitted questions through the chat, we'll follow up with a call and email to you to provide the answers very soon. And remember, keep an eye on your email for the link to today's recording. Thank you again for all you do for Protective. Thank you for your business. And we look forward to seeing you on our next Protective University webcast. Have a great day, everybody.